So NVIDIA just reported this staggering 65% jump in revenue, right? And they are currently sitting on a mountain of like $62 billion in cash.
Yeah, it's a massive war chest.
Exactly. So why are some technical analysts quietly flashing sell signals right now? I mean, they're pointing to a falling trend. That is the multi-billion-dollar question we are answering today.
It really is kind of the ultimate standoff right now.
Right, because we are looking at a company that is undeniably a force of nature, but the data is showing some incredibly conflicting friction beneath the surface. Like, are we looking at a screaming strong buy that's just heavily undervalued, or is this, a classic value trap waiting to catch retail traders off guard?
Well, you have absolute fundamental dominance pulling the narrative in one direction, and then a very stubborn technical reality acting like a brick wall in the other.
And breaking down that wall is basically our mission for this deep dive. We're completely unpacking the April 13th, 2026 data on NVIDIA, ticker symbol NVDA.
Yeah, we've got a lot of ground to cover.
We really do. We are going to look at the raw financial statements, the technical charts, the underlying psychology of the Wall Street analyst ratings, and the definitive bull versus bear arguments.
Because we want you, the listener, to understand the mechanics of what is actually moving this stock.
Exactly, so you can separate the signal from the noise. But before we get into the weeds, please take a second to like this video, subscribe to our YouTube channel, and leave your feedback in the comments.
Yeah, definitely leave a comment.
We read them, and it tells us what you want us to dissect next.
And, it also tells the algorithm that you value this kind of in-depth analysis, which helps us keep building these deep dives for you.
Absolutely.
But just to establish the ground rules before we get rolling, I want to make it crystal clear to you listening. This deep dive is a natural human debate interpreting the provided financial source material.
Right.
We are breaking down the math and the market mechanics, but absolutely no financial advice is being given here. We're reading the map, but you are driving your own car.
And I love that. And speaking of cars, I look at NVIDIA right now and I see like a Formula One car pulling into the pit lane.
Okay, yeah, I can see that.
Right. The chassis is flawless, the specs are terrifyingly good, and the driver just won the last 5 races. But it's just sitting there idling.
Yeah.
And as an observer, you have to ask, are they just changing the tires before setting another lap record? Or is there, smoke coming out of the engine?
That's a great analogy.
Thanks. So to figure that out, we have to start with the baseline of the company's sheer financial reality over the past year. Let's look at the fiscal year 2026 results because, they are nothing short of historical.
They really are.
Total revenue hit $215.94 billion.
Which is just, a 65% year-over-year jump on a revenue base that massive.
Uh-huh.
It defies the traditional laws of corporate gravity.
It does.
Most hardware companies hit a scaling wall long before they reach $250 billion in sales.
And the crazy part is they aren't just selling more. They are keeping an absurd amount of it. Net income sits at $120.07 billion.
Right.
With operating income at $130.39 billion. And diluted earnings per share is up to $4.90. But the number that really jumps off the page for me is the gross margin.
Oh, yeah. The 71%.
Yes, 71.31% over the trailing 12 months. And I have to push back on this a bit because a 71% margin is what you expect from a software as a service company, right? Where it costs $0 to duplicate a line of code.
Exactly.
NVIDIA literally builds physical, incredibly complex silicon chips in massive fabrication plants. How is a hardware manufacturer pulling off software-level margins without a competitor undercutting them on price?
Well, it's because they aren't really just a hardware company anymore.
Okay, what do you mean?
They're selling an entrenched ecosystem. When a massive data center decides to upgrade, they aren't just buying the physical Grace Blackwell GPU.
Right.
They are buying into the CUDA software platform. They're buying the NVLink networking architecture that lets, tens of thousands of these chips talk to each other simultaneously.
So it's a whole package deal. Exactly. Developers have spent the last decade writing their AI models specifically for NVIDIA's proprietary stack. So, a competitor could theoretically build a faster or cheaper piece of silicon.
But no one would buy it.
Right. The data center won't buy it because it would require rewriting millions of lines of code. The switching costs are just astronomically high.
Oh, wow.
So that walled garden gives NVIDIA total pricing power, hence the 71% margin.
So they've essentially built the iOS of supercomputing. You can buy a cheaper phone, but all your apps and data are locked in the Apple ecosystem.
That is the perfect way to look at it.
And that dominance clearly shows up on the balance sheet. I mean, total assets are $206.8 billion. Compare that to a total debt-to-equity ratio of just 7.25%.
It's practically unheard of.
Right. And they have $62.56 billion in total cash on hand. Their cash from operations is $102.72 billion, with $34.9 billion in free cash flow as of January 2026.
And those cash flow metrics, they are the company's actual moat.
Because in a macro environment where borrowing money is expensive, having a debt-to-equity ratio of 7.25% makes them practically immune to high interest rates.
That makes sense.
But more importantly, having $34.9 billion in free cash flow means they can outspend every single rival in research and development combined without ever touching a bank loan.
So they're funding the future in cash.
Exactly. They can fund the next 3 generations of microarchitecture in cash while their competitors are struggling to finance Generation 1.
Wow. But see, here's the thing. All of that cash, all of that software dominance, and all of that fundamental perfection isn't translating into an all-time high today.
No, it's not.
This is where the friction really starts. Over the last 52 weeks, the stock hit a low of $95.04 back in April 2025 and reached a high of $212.19 in October 2025.
Right.
But as of today, April 13, 2026, the stock is trading at $189.31, which is up just a slight 0.36%. If the company is a flawless money printing machine, why are we $20 off the high?
This is where we really have to separate the company from the stock.
Okay, unpack that for me.
A company is a fundamental entity, right, governed by balance sheets and income statements. A stock is a psychological asset governed by order flow, institutional algorithms, and technical positioning.
So the two can be totally disconnected.
Exactly. The company is executing perfectly, but the stock is currently digesting a massive run-up and hitting technical roadblocks.
Yeah, I look at the midterm charts and I see some serious conflicting signals. We've got a bullish reversal pattern, specifically a double bottom.
Yeah, the classic W shape.
Right. But at the same time, the overarching trend direction has analysts warning of a broader bearish trend. There is some short-term momentum, sure, but it's smacking right into a massive block of strong resistance sitting right above the current price, like between $190 and $190.53.
It acts like a dam holding back the price.
Right, like a glass ceiling. And the chart shows that a break above $197.72 is required to completely invalidate those bearish patterns.
And that $197.72 level is critical.
Why that specific number?
Because it represents the invalidation point for short sellers. If the stock crosses that line, algorithms that were betting against the stock are forced to automatically buy shares to cover their losing positions.
Ah, creating a squeeze.
Exactly. That creates a cascading short squeeze, adding buying pressure that essentially shatters that 190 dam. But until that happens, the stock is trapped.
Let's talk about the mixed signals inside that trap. You mentioned the double bottom earlier. To me, that tells a story of demand, right?
Oh.
The stock sold off, hit a floor, bounced, retested that exact same floor, and institutional buyers aggressively stepped in again because they saw value. That sounds incredibly bullish to me.
It does.
But then I look at the MACD indicator, the moving average convergence divergence. Some sources are reading the MACD as a buy right now at 2.18, while others are warning of a severe bearish divergence.
Ah, yes. The bearish divergence. It's really the silent killer of rallies.
How does it work?
Well, a divergence happens when the actual price of the stock is making slightly higher highs on the chart, but the underlying MACD momentum indicator is making lower highs.
Okay, that sounds technical. Can you give me an analogy?
Sure. Think of it like a car coasting up a steep hill. The car is still physically moving forward and getting higher. That's the stock price creeping up.
Right.
But the driver has taken their foot off the gas. The momentum is dropping. Eventually, gravity takes over. The momentum indicator is telling us the buying pressure is exhausted, even if the price is technically up today.
That makes perfect sense. And we actually see that exhaustion in the RSI as well.
Yes, we do.
The 14-day relative strength index is currently sitting at 66.44. Now, for you listening, the RSI measures the speed and magnitude of recent price changes. Anything above 70 is considered overbought.
Meaning the buyers have essentially sprinted too fast and need to catch their breath.
Exactly. So at 66.44, we are technically still in buy territory, but we are dangerously close to hitting that overbought ceiling.
Right. Now, the stock is technically supported. It's trading above its 50-day simple moving average of $182.01 and its 200-day simple moving average of $180.92.
Which act like algorithmic safety nets, right?
Exactly. Safety nets for institutional traders. But if that exhaustion hits and the stock starts falling back down the hill like we talked about, those safety nets will be tested.
And if that $190 dam holds, the sources point to key downside support levels at $175, $170, and a highly critical neckline at $161.35.
Yeah, that 161 level is crucial.
If it breaks 161, that is where the technicals get genuinely ugly.
Yeah.
However, standing in the way of that collapse is NVIDIA's own checkbook.
Yes.
We have massive insider and institutional order flow. Specifically, the $41.1 billion returned to shareholders in fiscal year 2026 through share repurchases and dividends.
A $41 billion buyback program is a tremendous mechanical advantage for the stock.
How so?
When a company buys its own shares on the open market and retires them, it reduces the overall float, the number of shares available to trade.
Supply and demand.
Exactly. It artificially increases the scarcity of the remaining shares, which props up the price. It acts as a massive shock absorber every time the stock dips toward those support levels.
Okay, so we have a stock wedged between a $41 billion floor and a $190 algorithmic ceiling.
That's a great summary.
Thanks. That brings us to the Wall Street professionals whose job it is to break this tie. And their consensus is overwhelming. I mean, out of 100 analysts covering NVIDIA right now, 97 have it rated as a buy or strong buy.
97 out of 100.
3 say hold,
Right.
and exactly 0 say sell. The median price target is $249.94, with a high-end projection of $352.
The conviction from Wall Street is just almost absolute.
But see, I look at 97 buy ratings and 0 sells, and honestly, I get very nervous.
Really? Why is that?
It's one of the oldest concepts in market psychology. If everyone is already on one side of the boat tends to tip over.
I see what you mean.
Like, if all 97 analysts and all of their institutional clients have already bought into the good news, who is left to actually buy the stock and drive the price from 189 up to 249? The good news has to be entirely priced in by now, right?
Well, the career risk for an analyst to issue a sell rating on the most dominant tech company of the decade is massive. Herd mentality is very real.
Definitely.
However, they are justifying these $300 price targets with valuation metrics that, historically speaking, look mathematically impossible to ignore.
Like what?
Well, the PEG ratio is currently sitting at 0.77, and the forward PE ratio has compressed significantly down to 23.21.
Okay, those numbers sound low, but let's translate what they actually mean for a retail trader looking at a screen. The forward PE tells you how much you are paying today for $1 of the company's expected earnings over the next 12 months.
Right.
Historically, hyper-growth tech giants trade at a forward PE of 40, 50, even 60. So seeing NVIDIA at 23.2i makes it look cheaper than some, utility companies?
Exactly. And that compression happens when the company's earnings, the E and the PE ratio, are growing substantially faster than the stock price.
So the denominator gets larger.
Yes, pulling the whole ratio down. And the PEG ratio, the price earnings to growth ratio, takes this a step further by factoring in the speed of that earnings growth.
Right.
A PEG under 1.0 is the holy grail for traditional value investors,
Right.
because it mathematically suggests the stock is undervalued relative to how fast it is growing.
I can totally see why a retail trader would look at a forward PE of 23 and a PEG of 0.77 and think this is a guaranteed win. Like, the math is screaming that the stock is on sale.
It really is.
But that introduces the fundamental debate of this entire deep dive. Is this a genuine once-in-a-generation discount, or are we looking at a value trap?
A value trap is one of the most dangerous phenomena in investing.
Explain that for us.
So a stock looks incredibly cheap on paper based on forward estimates. But the market collectively knows a secret. Those forward estimates are wrong.
Oh, wow.
Right. If the broader market believes that the explosive growth is about to unexpectedly slow down, they stop buying. If NVIDIA suddenly revises their earnings estimates downward next quarter, the E in that ratio shrinks.
And the ratio blows up.
Exactly. Suddenly, a cheap forward PE of 23 balloons into an expensive PE of 45 overnight without the stock price ever moving up. The trap snaps shut.
That is terrifying. And that ties perfectly into the definitive bull versus bear case we need to outline. Let's start with the bulls, who completely reject that value trap theory.
Yeah, they're not buying it at all.
Not at all. Their best case scenario is anchored in absolute exponential growth. I mean, we are talking about $62.3 billion in data center revenue in Q4 alone.
Which is staggering.
It is. NVIDIA has total dominance in AI inference via the new Grace Blackwell architecture, combined with the NVLink networking we discussed earlier. And their Q4 profit margin specifically hit 55.6%.
So the bull thesis is pretty simple.
Right. The AI revolution requires an unprecedented build-out of infrastructure, and NVIDIA is the only company selling the concrete and steel.
It is a phenomenal thesis. But we cannot ignore the worst-case continuation lower and the downside risks that form the bear case.
Let's hear it.
First, there is the technical weakness we saw on the chart. Some analysts are pointing to the potential formation of a bear flag pattern.
What does that look like?
A bear flag occurs when a stock suffers a sharp drop, that's the flagpole, and then slowly consolidates upward in a narrow channel, the flag.
Ah, okay.
It looks like a recovery, but it's actually just a breather before the sellers reload and drive the price down another leg.
Alongside the technicals, the bears are heavily leaning into macroeconomic and regulatory risks, right?
Big time.
We are seeing hawkish language from the Federal Reserve, warning of higher for longer interest rates. When the risk-free rate of return stays high, meaning you can get like 5% on a guaranteed government bond institutional investors demand a much higher premium for taking a risk on stocks.
Exactly.
And that compresses the valuation multiples they're willing to pay, dragging down the price of even fundamentally flawless companies like NVIDIA.
Multiples compression is just a massive macroeconomic gravity well, but there are also external supply chain variables.
Right, the geopolitical risks.
Right.
Now, the financial sources highlight that conflict in the Middle East is threatening global supply chains and heavily affecting oil prices. And I want to be super clear with you listening right now. We're looking strictly at the objective economics outlined in those sources.
Right, we're just reading the data.
Exactly. We aren't taking any political sides here. The risk to NVIDIA isn't political. It's purely about shipping logistics and energy input costs. If global shipping lanes are disrupted or fuel costs skyrocket, it directly impacts the massive globalized supply chains required to manufacture and distribute semiconductor technology.
Exactly. Even a perfect company exists in an imperfect, interconnected world.
Yeah.
If oil prices spike, inflation resurges, forcing the Fed to keep rates high, liquidity drains from the market.
And what happens then?
When institutional portfolios face a liquidity crunch, they don't sell their losers. They sell their biggest, most liquid winners to raise cash. They sell NVIDIA. And this cascade of macro events is exactly how the retail trap plays out.
That's a great point. Explain the mechanics of that retail trap. How does the everyday investor get chewed up by these macroeconomic forces?
Well, retail investors often trade purely on emotion and lagging technical patterns. They see the stock start to consolidate upward, forming that bear flag we mentioned.
Right, the breather.
They suffer from FOMO, fear of missing out. And they buy at the very top of the flag at, say, $185, assuming the stock is finally breaking out.
Oh, no.
Then the macro pressure hits. The Fed speaks, or oil spikes. Institutional algorithms trigger sell programs. The stock breaks down through that critical $161 neckline support.
And then panic sets in.
Exactly. The same retail trader who bought $185 out of greed sells at $150 out of sheer terror, locking in massive losses right before the stock eventually stabilizes. They just get chopped up by the volatility.
That is a brutal reality check. So, having laid out these massive opposing forces, the flawless fundamentals versus the macroeconomic gravity, let's synthesize the timeline. How does this play out over the coming weeks versus the coming years?
Well, looking at the short-term outlook, the consensus strongly points to consolidation.
Okay.
The stock is likely to just chop sideways, bouncing between $185 and $190.
Yeah.
The broader market is essentially holding its breath, waiting for a definitive catalyst to clear the fog.
And that catalyst is the upcoming May 20th, 2026 earnings report.
Yes, that's the big one. Meanwhile, the long-term outlook remains aggressively bullish. Institutional optimism is deeply anchored by the expectation of sustained, exponential AI demand across enterprise sectors.
And the highly anticipated rollout of NVIDIA's next-generation Vera Rubin architecture.
Exactly.
Looking at the short term, are traders genuinely just sitting on their hands until May 20th?
Yeah.
If the long-term outlook for Vera Rubin is so incredibly bullish, why wouldn't hedge funds try to front-run the earnings report and just buy up all the shares right now at $189?
Because the institutional risk management math just doesn't allow it.
Why not?
When a company is carrying the weight of the entire tech sector on its shoulders, its earnings report isn't just a reading of past performance. It is a validation of the entire market's belief system regarding AI spending.
It's a lot of pressure.
It is. The implied volatility leading up to these reports is massive. If NVIDIA misses their forward guidance by even a fraction of a percent, the stock could swing 10 or 15% overnight.
Wow.
A hedge fund manager doesn't want to make a multi-billion-dollar bet on a coin flip. They prefer to let the earnings report drop, let the implied volatility crush back down to normal levels, and then buy the confirmed trend, even if it means paying a slightly higher entry price.
Wow. We have covered an immense amount of ground today. Let's pull all these threads together.
Let's do it.
On one hand, you have a financial juggernaut. NVIDIA generated $215 billion in revenue, with a staggering 71% gross margin, armed with a $62 billion cash moat, and a massive share buyback program providing a floor.
It's basically a fortress.
Right. And you have a Wall Street echo chamber where 97 out of 100 analysts are screaming buy, supported by a compressed forward PE ratio of 23.20.
But on the other side of the ledger, you have a stock that is trapped below a stubborn $190 technical resistance dam.
Yeah.
You have the MCD indicator warning of a bearish divergence, losing momentum as it climbs the hill. And you have undeniable macroeconomic headwinds, from hawkish Federal Reserve interest rates compressing valuations to geopolitical conflicts threatening the energy supply chains that semiconductor manufacturing relies on.
It perfectly illustrates why investing requires a 360-degree view. You can find the best company in the world, but if the macro environment is wrong or the technical entry point is flawed, you can still get caught in a trap.
Exactly.
And as a final reminder to you listening, this has been an analytical deep dive into the mechanics of the market, not financial advice.
We talked earlier about that Formula One car parked in the pit lane. We know NVIDIA's long-term valuation is entirely dependent on the flawless execution of their future AI architectures, like the upcoming Vera Rubin chips. But I want to leave you with a provocative thought to mull over independently. What happens to this supposedly undervalued race car if the broader global appetite for AI suddenly plateaus?
Oh, wow.
If the massive tech giants who are currently spending billions on these data centers realize they have overbuilt capacity and the order flow suddenly slows down, does the engine finally stall?
That is a heavy question and exactly the kind of critical thinking required to navigate this market. Thank you so much for joining us on this deep dive into NVIDIA. Keep asking questions, keep looking past the headlines, and we will see you next time.